This is a mini learning module on finance and investments. The learning outcomes expected are to be able to analyze financial performance from financial statements, to calculate and apply time value of money concepts to investments, and to relate principles of financial management in the context of international business. It's important for managers to be able to interpret financial statements to understand company profitability. There are two essential statements that make up a set of financial statements: the balance sheet and the income statement. The income statement is a report that summarizes a firm's revenues, expenses, and profits during a specific period of time. Some companies will report this on a monthly basis, and some companies will report this on a quarterly basis, depending on if they are privately held or publicly traded. One of the key advantages of the income statement is that it gives information on revenues, and it's seen as a source that provides people with revenue information. It also digs deeper into the normal costs and additional costs that affect the gross income earned. One of the disadvantages of the financial statement's income statement is that it does not detail money due from accounts receivable, and it doesn't always provide the full landscape of what occurred. Often in my company, if we have a huge expense like a logistics fee or some sort of one-off expense, and it gets put into a certain month, it doesn't accurately reflect how that month came out. So our finance manager will often put notes in there to make sure that the CEO is aware that this is a one-off situation and it doesn't normally happen. The balance sheet is also very critical because it identifies what the company owns and what the company owes. So examples of things the company owns would be equipment, cash, and accounts receivable. Items that the company owes would be accounts payable and any loans that the company may be paying back. Getting into the time value of money. Time value of money can be utilized to compare investments like loans, mortgages, leases, 401k savings accounts, and annuities. The concept says that the dollar amount that you have today can be invested and worth more at a future date. It also allows you to identify how long something will take to be paid back, as well as the monthly payment including interest. Some of the key terms to focus on when you think of the time value of money are present value, future value, simple interest, compound interest, the number of periods, and loan amortization. Present value is defined as the dollar amount today that's equivalent to future payment or payments discounted by a specific interest rate. Future value contains a fixed or compounded interest rate that will grow by the time there's a future date of payoff. Simple interest is calculated on the original amount borrowed, whereas compound interest is calculated on the original amount plus the interest accrued. So if a company also borrows from a bank, they will sometimes use a loan amortization schedule, where the loan will be paid in equal installments. This is really helpful on a large loan, so that principal and interest get paid down instead of all the payments being dedicated to interest. Also as you calculate any of these present or future values, you want to keep in mind the number of periods, as that will help you identify what these installment payments will look like. Getting into the principles of financial management. More and more companies are starting to do business internationally, and financial managers need to have an understanding on the specific accounting methods that are utilized in the region that they are doing business. GAAP is known as the Generally Accepted Accounting Principles, and it's used in the United States, whereas IFRS is known as the International Financial Reporting Standards, and that's utilized internationally. There are three major differences between GAAP and IFRS. Those three differences are intangible assets, inventory costs, and write-downs. IFRS is considered to be more principle-based, whereas GAAP is seen as rule-based. So under GAAP, if an asset is intangible, it is recognized as what's known as fair value. IFRS will only recognize intangible assets if the asset has a future benefit and is seen as reliable. So an example of this would be an advertising cost, which can be challenging because you don't always know what your return on investment is with advertising. Last in, first out, also known as LIFO, is a standard inventory method that's utilized by many companies. IFRS doesn't allow the LIFO method of inventory costs, where GAAP analysis allows LIFO or FIFO, and FIFO is first in, last out. So, and then lastly, write-downs of inventory can be reversed in the future if a specific criteria are met under the IFRS principles. Under GAAP, reversals of write-downs are forbidden. Some supplemental materials that I wanted to share. There's a video at lynda.com that really provides you with a good introduction on financial statements. Gives you an overview on each part of the financial statement and how to interpret them. The next video that I wanted to share was how managers should read financial statements. That's always important too, because managers don't always need to really dig into every line. There are really key specific areas that they can dig into. The time value, money introduction, and calculation formulas, I've placed a video here, and it also shows different formulas that you can use to provide this calculation. The International Financial Reporting Standards and Generally Accepted Accounting Principles, there's a video about their similarities and their differences. And then lastly, I have another YouTube video on US GAAP versus IFRS on the financial statements. After going through this, I have 3 discussion questions. The first one is to research a merger or acquisition of a company. Identify how and why the financial statements are a key component to this process. What specifically would a company be looking for in the financial statements if they were trying to acquire or merge into another company? The second one is research a publicly traded company's annual report that has both operations in the U.S. and internationally. Identify what accounting principles they utilize, GAAP, IFRS, or a combination. Identify the challenges that could arise for a company having to utilize both principles. And then the third one is identify a savings account that you currently have, 401k, general savings, etc. Describe the process you went through when you set up your investment in relation to the time value of money. For example, if you have a 401k plan, describe your process on identifying how much you want it to contribute. Thank you for listening to my Finance Investments mini learning module.